Okay, so I wasn't really sure what kind of an audience to expect, so I kind of have a presentation for a non-specialist audience, so I apologize for my colleagues here, but I also have the paper, so if you want to ask more detailed questions, go ahead. So this, also there was another another presentation after me which was canceled, so we have more time than we need. So again, I encourage you to ask questions. Okay. So the title of my paper is Case Against Active Pension Funds, Evidence from the Turkish Private Pension System. It's joint work with Atakan Yalçın from Özyeğin University. Okay. So let me motivate this by saying that this individual pension system in Turkey started at the end of 2003, but since then there hasn't been any academic studies on them. Okay, so we pretty much don't know anything about the performance of these funds. Okay, it's a system that's been growing exponentially, and both because the economy has been growing and also because of the government subsidies. So it's important to know how well these funds are doing. Okay? One problem, one thing that when I came here, obviously, after I got my PhD and started having a salary for the first time, was, what to do with that money. So, Gökçen asked me if I want to put it into a pension fund, into the pension fund system, and I wasn't exactly sure because I didn't know much about them. So I started asking around, and it occurred to me that a lot of people were pretty much lost in terms of how to choose a fund, or whether to actually opt into the system or not, okay? Because it was kind of a non-proven thing. It was a new thing in Turkey. So people were a little skeptical, and the people who have invested some of their savings within this system only kind of knew about the performance of the funds they were investing in. Okay? So they didn't have a kind of a big picture view of how the pension fund system was performing. So that sort of motivated me and Atakan to actually look into this with a little more academic rigor. Okay, so our goal with this study is to provide an unbiased analysis of the performance of these funds and the pension fund industry in Turkey. Sometimes, you would, obviously if you go to any of these pension fund companies, okay, you can look at their performance, their track record, but most of the time the things you hear, while they're not wrong, okay, they're somewhat, they don't necessarily represent the whole sample, okay? So you may just be looking at the good performance, or some of the funds, let's say if they've closed down, okay, you wouldn't necessarily see their performance. And we hope that our findings will help individuals make better decisions about their savings, and also the fund companies to offer better products. Okay, so again, like I said, I wasn't exactly sure what kind of an audience I would have, so I decided to start by, first of all, defining what active and passive means, okay, in fund management. Okay, so we talk about active management and passive management. Active management meaning that the fund manager makes decisions about what to buy and sell and when to buy and sell them. Okay, so we call these security selection and market timing. So the idea is that the fund manager is going to add value, okay, through his decisions on security selection and market timing. So clearly, okay, this is a very sort of niche business, requires knowledge, skill, resources, etc. So it's going to be costly, right? On the other hand, the passive approach is just replicating an index. So you pick an index like the S&P 500 or the Istanbul Stock Exchange 100 stock index, and then you just buy and hold those stocks. Okay? So the attraction of this strategy is that it's simple, okay? It's cheap, right? You don't have to make any decisions. You can't really go wrong. Okay?
It also has rebalancing costs, right?
What?
In the passive strategy, it also has its rebalancing costs, right?
It does, of course, but most of the time, so it's not completely free, but usually if you look at the expense ratios of US funds, the passive funds are usually, will have expense ratios maybe 1/10 or 1/20th of an active fund. So the active fund is much more expensive to run. Okay? So you can obviously do much more economies of scale with the passive fund. You're also not trading, so there are very little trading cost. With the active manager, he might be trading every day, for example. Okay, so this is something that usually I ask my students in the investments class. I ask them what approach is better. And inevitably, a lot of people think the active approach is better, because obviously how can it be otherwise? There's someone there who supposedly knows what they're doing, and so they're supposed to do a good job. Okay, but if you look at the academic evidence, that doesn't turn out to be the case. Actually, the academic studies find that the average active fund manager does not really add any value over the passive index. Okay? So that's one of the reasons why the indexing approach, both in mutual funds and the exchange-traded funds, have become extremely popular. So that's clearly an indication that there's a huge demand, okay, for indexing. At the same time, okay, we've also seen the growth in hedge funds. Okay, so that's almost counterintuitive. So on one hand, there are a lot more people who are investing with index funds, the passive approach. Okay, but at the same time, there are a lot of people, okay, who don't want to do that and who want sort of more of a high-risk, high-return strategy with the active management. Okay, so interestingly, there's sort of space for both of these approaches, and whether one is better than the other is still a topic of debate. Okay. Okay, so let me just now jump to what we're doing. Yes.
Can we ask questions?
Oh, yeah, go ahead.
No, but the thing is, it depends on the size of your funds. Like hedge funds, I cannot invest in hedge funds because I'm a small investor.
That's right.
But I can invest in the pension fund because that makes sense. So in that regard, a more retail investor goes for the passive managers in that, or passively managed funds, whereas the active managed funds are required
catered for,
because you can pay for the management fee. The management fee is
that's
quite
right,
high.
but there are also things called the fund of funds. So for example, a mutual fund company or a bank, okay, will create a fund of funds, so which will sort of have this pool from retail investors, and then that manager then picks, let's say, 10 hedge funds to invest in. Okay? So there's a lot of money that kind of flows into the hedge funds sort of through these indirect channels. On top of that, there are also active mutual funds, which, though technically they're not hedge funds, okay, a lot of their investing is sort of similar to hedge funds. Okay? So my point is that there is a lot of demand for active investing. People just don't like to sort of sell for average returns. Okay? Even though, like I said, the amount of money has grown in index funds, it has also grown in active funds, which is something of a puzzle, if you want to think of it that way. Okay, okay, so let's come to Turkey. Now, one thing that attracted me to this study was that we had really good data. Okay, so this data is purchased from data provider Racionet, and they compile it from the regulatory filings of these pension funds. These pension funds are supposed to report their assets, okay, net asset values, and also their asset allocations at the end of each trading day. Okay? And then, of course, this data has to be public, okay, because of transparency rules. And this is not something you normally see in the U.S. Okay? Most pension funds in the U.S. only have reporting requirements every quarter. With mutual funds or exchange-traded funds, yes, you can get net asset values every day, but you can't, for example, get information about portfolio holdings. Okay, so the data is really clean. It's also free of any kind of survivorship or selection bias. Okay, so one thing, if you're not doing research in this area, a problem is if you're using a database that, for example, uses funds that report. In other words, that database only has funds. It doesn't have the complete universe of funds, but it only has funds which have chosen to report their returns. And usually that tends to bias things upwards because the funds that are not doing well tend not to report their performance. Okay, so that's one issue. The other issue is survivorship bias, where if a fund does really badly, it will close down inevitably. Okay? And then when it's closed down, if it's thrown out of the database, then that again creates a problem for the researchers that your results will be biased upwards. So we don't have any of these problems because we have a full universe, and the data is really clean because it needs to meet the regulatory requirements. Okay, so the sample period is from 2004 to the end of 2011. We use weekly returns. We actually have daily data, but we decided to convert it to weekly just to get rid of some noise. Okay, so in total we have 157 funds. These funds are in different sort of styles. Funds also report sort of their style and their benchmarks. So these styles are flexible mixed balance. Well, what this means is a fund can choose to call itself a flexible fund or a mixed fund, meaning that they're sort of free to do whatever they want. Okay? Or they can report themselves as equity funds, where they invest in mostly stocks, or government external debt, government internal debt. This is the Turkish government securities, bonds we're talking about. There are 9 international funds and 20 money market funds. Okay, so there's quite a variety there. Okay.
Do we know how they manage their funds?
What do you mean?
In many of these funds, money is managed by portfolio managers.
That's right, that's right.
Okay, each portfolio.
That's correct, yeah.
And the way they act is also important here. So it's not that company, it's not managing the fund. Do you know?
Yeah. So when I'm talking about the funds here, I'm not talking about the fund companies. I'm talking about the managers. Okay, so that's obviously also interesting. So that's something we plan to look at, in a follow-up study, whether there's any difference between the fund companies. But in this study, it's sort of a more micro level where we're looking at each individual fund, okay, which is managed by some manager.
But that seems important. People have looked at favoritism or subsidies within fund families.
Yeah. No, you're right. So that's something
it's not favoritism, but it's like every bank has its own portfolio
management.
Company.
That's right.
But by the new law, it's changed such that part of your overall fund has to be managed by some outsider. Okay? And even if even if your funds are managed by portfolio manager in your group of companies, what happens? You have to give a criteria to them, performance criteria. And generally, performance criteria is like BIST 100 index. And then they try to beat that. They don't want to take active. That's what active passive. So they just want to be around the BIST 100. That's it. They don't want to go too active in that. So you need to take into account the link between some kind of what they call principal-agent relationship between the fund company and the management company.
Well, let me explain it this way. So that goes into the question of what generates performance. Okay, so that we're not looking into that in the study, but that's kind of our follow-up. Okay? So in this part, we're just looking at whether there is, what the performance is like, whether there is sort of overperformance or whether there's underperformance. Then the second question is, of course, there's a distribution of performance. There are good, there's good performance, bad performance, and a lot of stuff in the middle. The question is obviously what factors determine, which funds do well and which funds do badly. So that question I can't answer right now, but maybe next year we'll have another paper on this. Okay. Well, I also want to point out that we measure performance before fees. Okay. So the idea here is that whether the manager is adding any value. Okay, whether as a retail investor you would capture any of that value is another question. Okay, that's one of the reasons why the passive indexing approach has become very popular in the U.S. because even though we find positive sort of performance, overperformance of active managers, okay, because they also charge higher fees, the retail investor ends up slightly being better off with the passive fund, okay, because the extra performance that the manager generates is not passed on to the retail investor. So that's why we're looking at performance before fees, okay. So remember that every number you see is not actually the number you would earn if you would kind of invest that way. Okay, it would be reduced by the amount of fees. Okay, so this is kind of the first pass of just looking at some descriptive statistics, but it gives pretty much gives away the whole story. Okay, so panel A we have the funds, panel B we have the indexes. Okay? So let's just look at the first column, the mean return. So that's, the numbers are annualized percentages of weekly averages. So you take the fund's average return, okay, then you average it across funds. Okay, so you have 157 funds, you take the average of those 157 numbers, and then you multiply it by 1200 to make it an annualized number. Okay, so the average fund, that first row, had a mean return of 11% per year. Okay, and that looks kind of nice, right?
Why wouldn't you consider geometric holding period returns?
Good point. We've tried that too. We pretty much got the same result. We just thought sort of the simple average is a little bit, more relevant in the sense that the idea is, if in any given year, if I were to invest with any one of these funds, because remember, the question is, I don't know which fund to invest in. If I randomly pick a fund in a random year, what do I expect to earn?
Because given the standard deviation, you would expect the holding period return much lower than your annualized weekly return.
Yeah.
So are you saying that the cross-sectional differences are not affected, or the level itself is not affected?
Cross-sectional differences.
Between the funds.
I'm not sure I get this.
Did you actually analyze the geometric holding
Yes,
period
we did the
return?
same thing with the geometric average as well.
But given that the standard deviation is so high, you would expect the geometric to be much below the number that you report.
Okay, and so what's the point?
I thought you just explained the geometric returns look just like the arithmetic ones.
Oh, by just like what I mean is they're still below the index numbers. That's what I was going to say. Okay, so you're seeing the 11% return, which sounds good to many people, but then if you just you need to compare it to something. So if you compare it to the Turkish, the index returns,
So
it's
most of that standard deviation is market risk.
that's true.
Right?
Yeah, that's right.
Yeah.
Yeah, that's right. So the Istanbul Stock Exchange 100 index had a mean return of 17% on average. The second number, Kaya, the overnight brut, that's the repo index. That had a 13%, almost 14% return. Kaya de Tüm, that's the index of all Turkish government bonds. And that had about 16% return. Yes?
This is the time period 2004-11, right?
No, yes, 2004 to 2011.
So this is, as far as I know, a period in which the stock market exchange was very successful in Turkey overall. In terms
I'll show you a
total
picture of that.
gains.
Yes.
So could your findings be biased by that?
Well, in a way they are. I mean, you can think of it this way. So this is the picture of just the cumulative return over this period. So I think, so if you look at the figure on the right, this line, this series, that's the stock market exchange over this period. So if you invested $1 in the stock market, the Turkish stock market in January 2004, okay, by the time you got to the end of 2011, okay, you would have ended up here. So that's about maybe you more than doubled kind of your money. Okay.
But if you left around mid-period,
yes. So if around,
you would be better off with the.
Well, yeah, you can see that after the financial crisis in 2008, here we have a severe drop here. So if you sold here, you would have actually lost money. If you kind of held on, or if you bought it here, you sold it here, you would have maybe tripled your money. So one thing that we like about the sample period is their ups and downs. So in that way, we think of it as a kind of representative time period. Okay? Yeah.
But even the equity funds is not able to beat the stock market.
That's right. So that's sort of the
equity fund is around 13%.
yeah. So let me kind of
Equity fund
But
invest in
equity
stock
is
Yes.
market, right?
13.55, 17.78.
yeah. So that's sort
So
of
they selected the wrong stocks.
So
you can think of it that way.
instead of putting there, if you put your money in the list 100, that's you get more return.
That's
what-
right. So if you look at the mean return of the equity funds, it's about 13.5%. With the stock market index, it's about 18%. Okay. Now, if you look at this column called the benchmark adjusted return, okay, so that's a number that the funds report themselves because the funds are required to report a benchmark. So the benchmark is a combination of index. So if you're an equity fund, the benchmark is probably the BIST 100 index. Okay, if you're a government fund, it'll be some kind of a bond index, or it can be some combination of these. But the fund actually self-reports that index or indexes and the return that those indexes, those passive indexes would generate. So the benchmark adjusted return is the fund's return minus that index return. Okay? And a lot of funds are evaluated on how much sort of extra return they provide over the benchmark. Yeah.
So these self-picked benchmarks.
That's right.
Can they be changed often?
They can be changed, yes.
And self-picked, so not outside imposed.
No, they're not. They're completely self-declared. And the balanced flexible mix, that category doesn't report it. So that's one advantage of being kind of a flexible fund. If you declare yourself as a flexible fund, you don't have to report a benchmark. That's right. The other ones all have to report. They self-select those benchmarks. And if you look at the benchmark adjusted returns, they're pretty much zero. Okay? Yes?
Does the benchmark include any possible liquidity position of the fund? Typically, if you look at the betas of equity of bond mutual funds,
Yeah.
relative to indices, you find that the average beta is below 1, between 0.8 or 0.95 or so, because they hold 10 to 20% in liquidity.
That's right.
If the benchmark does not include this liquidity, then on the average fund may be less risky than the benchmark.
It can be.
Basically means that using the arithmetic average induces a bias, possibly of the magnitude that you record, as an estimate for the geometric holding period return. If the funds, on average, are less risky than the index, then using geometric returns will make them look bad. So this goes back to what I...
Yes. But I mean, you're probably right about that in the sense that the funds are probably. I've looked at a couple of them just to see their portfolio positions, and like say the equity funds, they always keep some money in the overnight repos, okay, for liquidity, like you were saying. So if their index is the BIST 100, okay, they're always going to be under that. Having said that, like I said, they're free to change their indexes, and they actually want to look good compared to those benchmarks. Okay, so I think if the fund is systematically doing something different than the benchmark, I think they would go and change the benchmark.
Unless they're not used to reporting arithmetic averages. So
well, they're not. Yeah, they're not reporting arithmetic averages, but they
performance in the same way as your measure.
Yeah, well, what they report two things. First, on a daily basis, okay, it's just a daily return. So that's what they need to report. They need to report their own return and the benchmark return. Okay, so those two things have to be reported. Then every year, they kind of have this organization called the Emeklilik Gözetim Vakfı.
Prices, right?
Yeah, and then they do a kind of study. Kind of a descriptive study about the performance. They rank the funds according to their performance. And so that's a sort of a yearly cumulative return. So it's kind of a geometric return, if you want to think of that way, of the daily returns. And so funds obviously want to look good on their sort of annual percentage returns. This is obviously different because this is just the full sample period of 8 years. Okay.
Can I ask
Yes, go
The
ahead.
market, does the market have one single passive index fund?
Yeah, so in all of these, in all the pension fund sort of system, there are two index funds, which we throw out, obviously, because we want to look at the active funds. But out of the 150, I think there's even slightly more now, because more funds were founded in the last 2 years. So we have over 160 funds. And the fact that there are only two index funds is obviously a bit ridiculous. So
They exist.
they exist, okay, but they're not popular, and nobody, I guess, managers do not want to manage a passive fund. Maybe there's no fame or glory with managing a passive fund. It's kind of a commodity.
Do you happen to know the fees on those passive funds?
I don't think they're any different. We can check, but yeah, I would doubt that they're indifferent, because when we looked at the fees, because we were also interested in whether there's a dispersion in the the cross section of fees, but there weren't. The fees were originally, when the system was founded, the fees were really high, about 8% or so, of total. I mean, so it was, incredibly high. Then the government, the regulators, sort of realized that this wasn't really a good idea, and it wouldn't encourage people to get into the system. So they've been systematically forcing the funds to reduce fees, and they only reduce it to the amount that they can kind of get away with. So most of the fees are around, these days, I think, between 4 and 5%.
That's 20 times.
Yes, that's right.
20 times of an average index fund
Yes.
fee in the U.S.
That's correct. That's correct. I mean, it's unbelievable.
But the government gives you 25% when you just put money there.
Yeah.
So
25% over
if you put 100
20,
liras,
25 years.
no, but when you, so 100 liras is 125 liras.
No, I know, but
So out
then
of
you
that-
pay 2% over 25 years. Actually, you lost the subsidy and more.
I think the government gives you 25% every year.
No, on the contribution.
At the beginning.
Yes.
That's just an initial subsidy. Instead of 1, you have 1.25. But then you're going to
Yes.
lose
So every time you
3% of it over 25 years. You will lose 0.75 in
But
fees.
4-5 is, I don't pay 4-5. I don't know if anyone of you pays.
Yeah, I know how much they pay.
I pay
don't know,
about
it's less than
2%.
1%.
How is that possible?
No, it's because Yapı Kredi has a coach group class.
I have a
Okay.
special.
Yeah.
But Yapı
Well-
Kredi for coach employees has 1% fee.
Oh, okay. So, well, anyway, so the big picture here is that most funds are not able to meet their benchmarks. Okay, most styles. So the equity funds have a slight about 40 basis points. Government external lab has negative benchmark adjusted returns. So there doesn't seem to be any kind of overperformance here. And again, if you look at these pictures, one thing that strikes you is that they look extremely similar. And that's sort of what we've seen with the benchmark adjusted returns. The picture on the left is the sort of the index of these funds. So we have the composite index, which is the equal weighted portfolio, sorry, value weighted portfolio of all funds, and then the equity funds, government internal, and the international mix. And then on the right you have sort of the indexes. And you can see that they look extremely similar. So the funds are pretty much tracking what the indexes are doing. Yes?
I'm not really surprised that the average fund tracks the market.
Yeah.
In a way, the average fund represents the market.
Uh-huh.
What about persistence? So the few that
Yes.
outperform the market, do they
We'll
keep
get there. That's sort of my very last slide, so I'm hoping to get there. But bear with me. I have a little bit of a test on that. Okay, let's move on to some regressions now. Okay, so what are these regressions? Each column is a separate regression. The dependent variable is a fund style index. These style indexes are reported to us from the data provider. So they take all the funds in a given category, create an index of those funds, and then we regress those fund indexes on the passive asset class indexes. So what are these asset classes that we're regressing them on? Okay, we have obviously the Istanbul Stock Exchange 100 index. short-term government bonds, okay, long-term government bonds, dollar-denominated Turkish government bonds, and then the dollar exchange rate, and then some international indexes like the MSCI World Index, Emerging Markets Index, U.S. Treasury bills, German Treasury bills, and so on. So the idea is to sort of capture as much variation in these funds as possible and see whether these funds on average generate any kind of alpha. Okay, so if you look at now this bottom row that I've called the constant there, okay, so that's our sort of intercept term, which we hoped would be positive, but it's not positive, it's negative.
But can you do these regressions? I mean, all the variables have unit roots. So,
what do you mean?
So they are, they have unit roots, the time series, all the variables, they are indices or some kind of
Returns.
They are returns.
They are returns, yeah. So these are returns on these
Oh,
indexes. Yeah, so these are weekly returns on each of these indexes.
These are standard Janssen alphas he's getting.
Well,
Constant.
What? Oh, yeah.
Constant, sorry. Standard.
Okay, so this is sort of the extra, the return that's not explained by these indexes. And as you can see that most of them are not significant and they're slightly negative. And then the government external is actually statistically significant and negative. Okay, again, numbers are annualized. So, okay, if you put your money in an equity fund, okay, on average you'd be losing about 0.5%. That's what this regression is telling you. Okay, and if you look at the R-squares of these regressions, you'll see that they're pretty high. So these asset classes, so our regressors tend to be capturing the variation pretty good. So we think it's kind of a valid model. Yeah.
It would seem to me that these regressions implicitly assume that the managers adopt a passive style and they're trying to recover the nature of the passive style. If you wanted to analyze the performance of an active manager, you may want to use perhaps some dummies for up and down markets and the like.
Yeah, no, that's a good idea. That's a good suggestion. We haven't looked at that, but that might, yeah. Okay, so next set of tests. Now, I have, for those of you who are interested, I can show you the model in the paper. We're basically now looking at a panel of these funds. By a panel, I mean we're not combining the funds anymore. Okay, we're keeping each individual fund as its own return series. Okay, so that means we have a panel of 157 funds, and of course, I think about 400 or so months of returns. We have two models. One way, the first model is just an OLS with standard errors clustered at the time and fund level. The one I want to talk more about is the second one, which is the random coefficients model, where we're estimating population parameters plus fund parameters. Okay, so what we're interested in is obviously sort of the average alpha. In other words, does the average fund provide any alpha, any intercept, any value? Okay, so that's going to be sort of the population average. On top of that, of course, each fund will have its own estimate of the alpha, okay? And of course the other coefficients as well. Okay, so that's our second model, the random coefficients model. And again, you can see that the t-statistic of 0.24, there's really no alpha. Okay, so the average fund does not provide any performance over on top of these indexes. Okay, so let me show you this little histogram of these fund alphas. So the alphas plotted here are coming from the regression model in the previous slide. Remember, we have 157 funds. We estimated the population parameter, the average, which was not any different from 0. But then there's, of course, being a variation around that average. And this is what this histogram is showing. So you can see there's quite a bit of variation. Even though the average is still around 0, there are also lots of funds with positive alphas. So obviously some with negative alphas. Okay, so there's, some managers seem to be doing well. some managers seem to be not doing so well. Okay? Now this gets to theory's question about persistence. So this is not a full-blown sort of rigorous persistence test, but it's kind of a test that I thought would be intuitive and practical for the retail investor. So what we do here is every year, at the end of each year, okay, we look at the best 10 funds of that year. By best, I mean the highest performers. Okay, so then you take those top 10 funds, divide your money equally among them, hypothetically, and then hold them for a year. Okay, next year, at the end of next year, you do the same thing. You look at the top 10 funds, rebalance your portfolio, hold them for another year. Okay, so that's what you see the return of in the top 10 benchmark column. Okay, the risk-free bonds and stocks columns represent, again, the Istanbul Stock Exchange index return, the government bond index, and the overnight repo index. Okay? So if you invested with these sort of supposedly best managers every year, you can kind of see that they don't always do better than the indexes in the following year, in the subsequent year. And so, for example, your performance in 2005 based on, so these guys have been the top performers of 2004, okay? And in 2005, for example, their performance is much less than like the stocks and the bonds indexes, okay? And then, you know, if you kind of follow this along, you won't necessarily see a pattern here. What I'm saying is sometimes they do better in the indexes, sometimes they don't. Okay? If you average across these years, what you see is that if you follow this strategy for these 8 years, on a typical year you would earn about 18%. If you just put your money in the stocks, on average you would have earned about 21%. If you put your money in bonds, you would have earned about 16%. If you average those two, so let's say if you put your money, half of your money in bonds and half of your money in stocks, you would have earned about the same as these sort of supposedly top managers. Okay? Panel B does the same thing, but with the cumulative return. So the idea is if you put 1,000 liras in with these managers at the beginning of the period, how much would you end up with today? Okay? Well, I'm missing a zero here. Oh no, so this is the holding period return. Okay, so your $1,000 would have grown to 2,754 liras with the top 10 managers. Okay, it would have grown to about 2,000 with the stocks, would have grown, and then about the same for the bonds. So again, the second one, the cumulative, shows you that you could have done just as well as those managers just putting your money in Turkish government bonds. Okay, so overall, I mean, like I said, this is not a test of every single manager. This is just the sort of the top performing managers, but it's a strategy that a retail investor could implement. And my point is that there doesn't seem to be any value in following a strategy like this. Okay, so I'm glad that we didn't have another seminar because it ran almost over time by 20 minutes. But let me just conclude. So we failed to detect any overperformance of these active funds. We have a few more tests in the paper which I've left out of the presentation. So if you're interested, I can talk about that later on. We see that there's some really good performing managers, but they don't seem to be able to repeat their success. And now, when Atakan, my co-author, talked about this study with some fund managers, you know, they were not exactly happy about these results. Okay, but you know, we're not really pessimistic about these results. So we don't think of these as showing these managers in a bad light, because this is pretty much consistent with what we know about US pension funds and mutual funds. Okay? Even in those sort of more developed markets, which have had, you know, years and years of experience with this kind of business, okay, they don't tend to overperform either. So it's not necessarily the case. This is not something specific to the Turkish money managers. Okay? So one important, obviously, policy implication is for Turkey is that we need more low-cost index funds. Okay, so that's sort of our takeaway from this paper, that there are these lot of managers who are trying to sort of beat the market, but most of them can't seem to do that. Okay, so why don't we instead get a cheaper product, okay, which will just follow the index? Okay. Any questions? I'm pretty much done. Yes, go ahead.
Perhaps an indirect way to analyze the same problem would be to simply study if there is a potential profitability in active trading strategies. Let's say the standard size value.
Yeah, very good idea. Yeah, we haven't done
If
that.
you find evidence for that, you could just as well conclude, let's just not allow these managers to even try to outperform the market.
Yeah,
There's
that's
a lot of evidence that this is possible.
Yeah, that's a good point. We haven't looked at that. It's a good suggestion.
And
Yeah.
If I may, I have a number of non-expert comments.
Okay, great, thanks. Yes.
Okay, so everything I say stays in this room.
All right.
Cannot be used again.
Yeah.
So the lesson I draw from this
Uh-huh.
as a risk-averse financial services consumer is
Okay.
not to invest in the.
Not necessarily.
Okay, that's the lesson I draw, because it seems to me there is kind of this imperfect information problem for the individual investor. How can we know which fund manager is more successful?
Well, what I'm saying is, this problem is exactly the same as a problem you would have anywhere in the world. Nobody knows. Okay, so there's no way to avoid this. There's a sort of famous study by Burton Malkiel, who does, he's a big proponent of the sort of passive indexing approach. And he took, I think, the idea that, what if you invested with these sort of top managers every year? So he looked at the Forbes magazine's top sort of honor roll, best funds of the year list every year. And then he sort of tracked that. He did this sort of hypothetical strategy where, what if I invested with these sort of Forbes best honor roll managers for whatever years, 10 years, 20 years. And what he found in the end is, on average, he would have earned the same as he would have earned by investing in the S&P 500. Okay, so it's similar to what we find here. So there's almost no way to know before the fact which managers are going to do well. So that's not. So what I'm saying is, that's not necessarily a reason to say I'm not going to invest at all, because even if you're not getting into that system, you have to do something with your money. So that means you're going to have to invest in yourself. Now, whether you're going to do a better job than those managers is, of course, questionable. So, yeah, so, there's no way around that question. Either you have to make that decision or you have to delegate that decision to someone else, which in that case makes your decision picking that manager, which is not easy.
Okay, my second comment is, if the Turkish government also makes a policy change,
Yes.
like it's in the US, and transfers most of social security funds into these, what are called
Private pension funds.
What would be the implications? Who would be the winners? Who would be the losers? Would we be the losers, would you say, and the financial services industry the winner?
Well, the financial services industry is always the winner because they make most of their money through fees. Okay, so it's an economies of scale argument. The more money flows into the banks, into financial services, okay, the more money they're going to make. But that's not to say that they're going to do a worse job managing that money than the government does. So the point is, at the end of the day, somebody has to decide what to do with that money. So I mean, I would have more confidence, trusting a manager with some, with some experience, with a good education, that kind of stuff. Maybe, an MBA from Harvard or something. So those are kind of things that people look at. Experience, past track record, education, and of course the style of the fund. I mean, you might have a great manager, okay, but he may be investing in I don't know, let's say emerging market countries, and you may not, let's say we living in Turkey, we may feel that we already have enough exposure to emerging market economy risk, so maybe you want to invest in safer countries or something like that. So yeah. Questions?
Questions. Policy.
Yeah.
It seems to me it would make sense to have a national index fund with low fees that represents
Absolutely.
an option.
Yeah, absolutely. That would be a great thing.
If there isn't a low-cost index fund.
Yes, so that's, you know, so for those of you who kind of missed it, these indexes that I was using as sort of the regressors, you know, in all of these tests, are not things that you can invest in. Okay? They are mathematical constructs, okay? So it's not, so I'm showing you that the funds are not, let's say, outperforming the Istanbul 100 stock exchange index, but there's no way you could invest in that directly anyways. Okay? So they're not really practical alternatives. So it's important that you know, we'd be offered some kind of tradable index. Okay?
There are mutual funds to track the index, isn't it?
Well, there are much higher fees, obviously.
Really?
Yeah. Of course, there's also the tax sort of issues.
There are closed-end funds, like there are closed-end funds that you can buy their stocks and they even give you a return, a dividend return.
Yeah, no, I mean there are alternatives, but you know, they're not low cost.
Yeah. What about just the index futures contract? I mean, I have a brokerage account at Garanti Bank.
Yeah.
There's a whole lot of futures contracts.
That's right. That you could, but again,
But it's not in the pension system.
No, I
On
agree,
these,
I agree.
you don't-
But
Yeah.
the national initiative that you propose could just roll over futures contracts at really low cost.
Into a pension fund, yes.
yeah, that's right.
So pension fund management fees are too high, but the pension funds are too small. I mean,
That's right.
There are maybe 40 companies managing funds.
Pretty much, yeah.
Funds in Turkey.
Yeah.
So the overall system is too small, and if you talk to them, they say those system is too small. You cannot take advantage of the economies of scale.
Yeah.
That's why our fees are too high.
Yeah.
But because of the fees are too high, the
Yeah.
investments don't grow.
That's right. Yeah, it's a catch-22. That's right. Yeah.
And that's the
I was
25%.
wondering about my conjecture about this subsidy and the manager's performance. Would there be an effect after 2011?
Good question. I don't think so, because I mean, from what we've kind of learned by, or Altakan has sort of told me when we with these conversations with the, you know, the fund companies, is that managers are really evaluated based on how much they outperform their benchmarks. Okay? And so they're kind of fixated on alphas, and they're not really compensated on how much money is flowing in, or if I'm not mistaken, there are no sort of performance fees either. So let's say if there were, let's say in hedge fund you have performance fees where, you know, if you earn, you know, make a positive return, you may, you know, get 20% of those profits or stuff like that. So these guys don't have something like that. So I don't think it's going to make a huge difference in terms of how much money flows into the system. Okay, well, thank you for coming.
Thank you.